Chapter 13, Capital Budgeting. Hello all, Chapter 13, last chapter. All right, let's get into it. Chapter 13 is all about capital budgeting, or how managers plan significant cash outlays on projects that have long-term implications, such as cost reduction decisions. Should new efficient equipment be purchased to reduce costs? Or expansion decisions. Should a new plant or warehouse be purchased to increase capacity and sales? Or maybe equipment selection decisions. Which of the several available machines should be purchased? Or sometimes lease or buy decisions. Should new equipment be leased or purchased? And then finally, equipment replacement decisions. Should old equipment be replaced now or later? Capital budgeting is a process used by companies for evaluating and ranking potential capital expenditures that are significant. Learning about capital budgeting will give you insights on how managers plan significant cash outlays on projects that have long-term implications. The must-know for this chapter include understanding time value of money basics and knowing how to make decisions using the payback period, net present value, internal rate of return, project profitability index, and simple rate of return. The ultimate goal of capital budgeting is to figure out which projects will be the most financially beneficial to the company in the long run. There are two types of capital budgeting decisions. One, screening decisions, and two, preference decisions. Screening is the determination of whether a proposed project meets a minimum requirement to be acceptable. The typical analysis used is payback period, net present value, internal rate of return, and simple rate of return. Preference decisions, on the other hand, focus on selecting the best choice of alternatives from competing courses of action. The analysis here includes internal rate of return and project profitability index. For these types of analysis, understanding the difference between cash flows and net income is key. Cash flows are connected with capital investment projects. Methods such as the payback period, the net present value, and the internal rate of return analyze the cash flows related to the capital investments to make a decision. The net operating income considers accruals of revenues and expenses and not necessarily only cash. The simple rate of return is an example of a method that focuses on just incremental net operating income. Before crunching some numbers, let's make sure that you understand what is meant by required investment or initial cost, cash inflows, and working capital. The initial cost, also known as required investment, is the total cash outflow at the investment inception. By net, we mean cash paid for the initial investment reduced by salvage value of old equipment sold plus any increased need for working capital. Cash inflows represent the expected return that will occur from the investment. The annual cash inflows represent the change in revenues and costs due to the investment. Working capital is by definition the current assets for the firm. When a company takes on a new project, there may be an increased need for working capital, with the increase representing a cash outflow. Examples would include the need for additional cash, receivables, or inventories. At project end, the working capital needed initially is released and treated as a cash inflow. An effective analysis of capital project requires that we determine a cash flow stream that consists of all cash outlays for and inflows from the proposed capital investment. Using cash flows to evaluate capital projects provides a verifiable measure with which to delineate the costs and benefits of each project, which can then be used to prioritize and select projects on the basis of the greater expected returns. The identification of cash inflows and outflows is a means of making the impact of a capital investment project readily apparent to interested parties. Let's start looking at the various methods used to gauge the earnings potential of a capital budget. A little disclaimer here. The following discussion will focus on concepts and decision rules to give you a broad understanding of the methods discussed. I assure you that the light will turn on once you start doing drills. Once you practice, you should be able to look back at the following presentation and understand the value that each method brings to the decision-making process. But don't kid yourself. Knowing the why of doing things as discussed in this video will make problem solving more productive. So let's get into it. The payback period, or PBP, determines the length of time that it takes for a project to recover its initial cost from the net cash flows that it generates. In simple terms, it is the time it takes for an investment to pay for itself. The payback period can be calculated with even or uneven cash flows. For even cash flows, the formula is payback period equals investment required divided by annual cash inflow. For uneven cash flows, the analysis must track the unrecovered investment year by year. The result will always be expressed in years or fractions of a year. The shorter the payback period, the better the investment. The decision-making rule is accept the project if the payback period is less than or equal to the required payback period. Reject the project if the payback period is greater than the required payback period. The payback period is simple. It's basically a back of the napkin analysis. Most business professionals feel that it is good for ballpark estimates. Because it ignores cash flows after the payback period and ignores the time value of money, it's not a measure of profitability for an investment, and as such, should not be the sole basis for your decision to invest in any given project. A more highly regarded approach is the net present value, or NPV method. Net present value is a calculation that compares the amount invested today to the present value of the future cash receipts from the investment. In other words, the amount invested is compared to the future cash amounts after they are discounted by a specified rate of return. The data needed for calculating the net present value are the initial investment or cash outflow, the length of time of the investment, when cash flows occur, the amount of net cash inflows for each period, and the discount rate. The discount rate used is also known as the cost of capital or the hurdle rate. The discount rate is usually regarded as the company's minimum rate of return. To calculate the NPV, you'll determine all the company's future cash inflows, all the future cash outflows. You'll net the inflows and outflows to get a net cash flow, and you'll take the present value of those future net cash flows and subtract the investment from the total. The answer will be a dollar amount. The amount will be either positive, zero, or negative. The higher the NPV, the better. The decision rule is to accept projects if the NPV is positive. A positive NPV means that the present value of the net cash inflows is greater than the initial investment. It also means that the actual returns exceed the discount rate. You'll also accept the project if the NPV is zero. In that case, the present value of the net cash flows equals the initial investment, and the actual return equals the discount rate. You'll reject any projects with a negative NPV. In that case, the present value of the net cash inflows is less than the initial investment, and as such, the actual return is less than the discount rate. While the NPV is more complex than alternative methods, decision makers like using the NPV because it considers the time value of money and the entire life of the project. When used to select from multiple projects, always pick the project with the highest NPV. The internal rate of return is the rate of return of an investment project over its useful life. It's computed by finding the discount rate that equates the present value of a project's cash outflows with the present value of its inflows. The higher the IRR, the more desirable the project. The data needed for the IRR calculation includes the initial investment, the length of time of the investment, and the net cash inflows during each period. The answer from the calculation will always be an annual percentage rate. The decision rule is to accept the project if the internal rate of return is greater than or equal to the required discount rate. Reject the project if the IRR is less than the required discount rate. Business professionals like using the IRR because percentage returns are easy to understand. The Project Profitability Index, or PPI, is a useful tool for capital rationing, as projects can be ranked based on their PI, or Profitability Index. The formula used for PPI is to take the net present value of the project and divide it by the required investment. The higher the project profitability index, the more desirable the project. This method is used because it allows for the ranking of multiple projects. The data needed is the initial investment and the present value of future cash flows. The decision rule is to select the project or projects with the highest PPI. Accept projects if the profitability index is greater than 1, as these projects will create value for the company. You can be indifferent if the project index is 1, as this will be a break-even point for the project. And by all means, reject projects with a profitability index less than 1, as these projects will actually destroy value. The final method to be discussed is the simple rate of return, or SRR. The simple rate of return is also known as the accounting rate of return. Unlike the other capital budgeting methods that we've discussed, the simple rate of return method does not focus on cash flows. Rather, it focuses on accounting net operating income. The approach is to estimate the revenue that will be generated by a proposed investment and then to deduct from these revenues all of the projected expenses associated with the project. The net operating income is then related to the initial investment in the project. The formula for the SRR takes the incremental revenues minus the incremental expenses, including depreciation expense, and divides the total by the required investment. So we are taking the annual incremental net operating income and dividing it by the required investment. The decision rule is to accept the project if the simple rate of return is greater than or equal to the required simple rate of return, or reject the project if the SRR is less than the required simple rate of return. Like the payback period, the simple rate of return is simple to calculate. It's not a metric of choice, however, because it uses accounting income rather than actual cash flows and does not consider the time value of money. Smart decision makers use several calculations to determine which projects are most worthwhile. Use of several approaches helps management make thorough, informed investment decisions. Smart decision makers will always follow up their decisions with a post audit. This step checks whether or not expected results are actually realized. As we have already studied, variance analysis allows management to focus on the exceptions and make corrections to those things which need improving. By creating an overall structured process for evaluating capital expenditures, companies can develop long-term goals, estimate future cash flows, and control future spending. Once capital budgeting methods are put in place, management will be able to streamline the decision-making process, which can save companies both time and money. Well, folks, that's it. You made it. Time to do a few more drills to make sure that you are grasping what's in this final chapter. Thanks for watching yet another video. Again, best of luck to all of you.